Well, thank you very much. Good morning, everyone. Good morning. I hope you had a great last night and ready for the session. I should say first thank Peter and Laurie for inviting me here. It's a great honor to be at this conference. I truly mean it because my background, believe it or not, my PhD is actually in statistics and econometrics. The first day I was in statistics class at Wharton, and the professor told me that that the statisticians are those who are very good at with numbers, but not even with the personality of accountants. So it's so you can see that I managed to offend both statisticians and accountants. Now it's actually very good to be in the in crowd with you guys. My talk today, I'm going to first start off with the context of the valuation, the fair value or marking to market of corporate credit. And now I'll talk about the quant stuff, the loan valuation framework, because that's what our specialty is. And we're not really, at Moody's KMV, we're not really doing accounting research. We're more focusing on the risk management. But of course, valuation and risk are basically two sides of the same coin. Now I'm going to talk about the lessons learned from the recent market turmoils. There are a lot of pundits out there now, and certainly I'm one of them, so I'm going to punt on what lessons can be learned from the recent market turmoils. Then I'll talk about cross-border issues. After all, this is what the conference is about. And I'll provide some closing remarks. Before I get into the presentation, please do feel free to stop me if you need clarification. I usually like to tell the audience that I speak English, but also speak Jinglish. So if you need clarifications, please do let me know. First, let me give you an introduction of fair value measurement standard. I assume that you guys all know FAS 157, FAS 159s, right? No? Okay. Don't worry, let me give you a multimedia version of the introduction. The YouTube version. Sorry, somehow the sound is not on.
Jay-Z, the girl Beyonce, Kanye, Luda, Timberland, Van Dyke, but it's still pro, it's still pro, it's still pro. 159, always feeling like a brother, getting on the grind, money socks. No, I ain't done yet, just telling me that's what market time you get credit worsens. And the risk goes up, market value of the debt goes down, what's up? That's 159, it's legitimate.
It's a Friday, wake up in the late afternoon. Call my homie Ryan just to see what he's doing.
I'm putting on my tie, next my dress shoe. September 21st, yeah, that's true.
I'm reading Wall Street Journal, it's filling up my mind. We should go to Double Bears, cause it's lunchtime.
Travis just looked, this article was back. Matthew 59, this thing on screen.
Morgan Stanley, Lehman Brothers, and Goldman Sachs. They're recording at fair value, not at gap.
Matthew 59 gets them out of jail.
Sorry for the folks. They market down their debt, don't drop the soap.
They making it look like the business is hot. They recording names when they ain't making a lot.
It's what they do. They're fooling all their folks. Stop going getting funds, but they ain't breaking no rules.
Quarterly earnings need to look.
All right. In the spirit of time, I'll just stop it here. I can see that you guys have a lot of funds that I can understand that. Okay, let me give you a text version. It's just because this provides the context of what I'm going to talk about. And by the way, now you understand why all the lectures, all the talks are videotaped, because Peter is going to put all of them on YouTube. So, right? So the FAS 157, as I understand it, is basically you look at you divide assets into three levels. The first one is for those assets with observed market prices, for example, actively traded stock and bonds and so on. The second level are for those assets which don't have observable price, but they have inputs that are based on direct observable traded price. So for example, if the interest rate swap contract, the underlying, of course, is the underlying bonds. So you can price the derivative contract off the underlyings. The third one is, of course, the hardest one, where the assets, one or more of the inputs do not have observed inputs. And this is what people call those where you have to do some guesswork or model-based. Now, for today's talk, I'm going to focus on the valuation of corporate credit by banks. So, for example, for commercial banks, the assets that they hold to maturity are not generally reported at the fair value, and they're generally reported at amortized cost in the primary financial statement. Now, this has always been the case, and it's going to continue to be the case under FAFs 157 and 159. Actually, there have always been quite a bit of demand for fair valuing the loans or loan mark-to-market. So, for example, Henry Paulson, who was the CEO of Goldman Sachs before he took over as the Treasury Secretary, this is quote him in American Bankers 2002. He basically said that banks are not required to recognize the fair market value of their loan commitments or outstanding loans in their financial statement, even when
The fire alarm test is now complete.
that must be the
That's what risk is all about.
that's what risk is about. Yes, exactly.
The fire alarm test is now complete. Please review normal procedures.
Yes, I'm going to resume to normal procedures. So when he was talking about this was 2002, and this is right in the midst of the last recession, where you have a lot of investment-grade bonds and loans. Their value significantly deteriorated, even short of defaults. So the loans or the bonds to these companies, you see significant erosions of economic values. But the banks are not writing them down because they haven't defaulted yet. So his point is that economic cost of these outstanding liabilities is unknown to investors, regulators, or media, right? So this issue of marking loan book to market has always been a contentious one. So let me start with a bet about requiring banks marking their loan to market. How many of you have heard about this place called longbets.org? Raise your hand. Okay, you guys all hedgers, and you guys are not speculators. So this is the place actually you can publicly announce your prediction and put money behind it and bet on that. And the idea is that really to stimulate the public debate on issues that are of general public interest. So this gentleman, Stuart Brynan, who actually is quite active in this place, he works actually for one of the major banks. He predicted that U.S. accounting and banking regulation would not require that loan portfolio hold in banking book be marked to market before 2024. So he made the prediction in 2004. So this is the place you make your prediction and put your money behind it, and people can agree or disagree with that. And the website will track the outcome in 20 years, and the money actually goes to charities, right? So let me ask, how many of you agree with this statement? How many agree with the prediction that this will not happen in 20, this is that's like 16 years now? Again, you guys are hedgers, willing to bet. How many disagree with this? Okay, Larry is going to collect money after. Okay, so naturally, you guys are economists, and accounting professors. So actually, there's 3 people sided with the predictor and 8 sided with the opposite opinion. Now, let's look at the argument against marking to market of loan book. The primary one, which you have heard many times, is about the impact on the significant increase in earning volatility. Stuart acknowledged that there's tremendous benefit of marking loan book to market, but the biggest challenge is the significant increase in earning volatility. And the second point implied from a significant increase in earning volatility is very much manifest now, which is increased volatility would make it very difficult for banks to play stabilizing role in the economy and making it more difficult for them to obtain stable capital under the market stress, which is what's happening now. Besides those points, there have also been a lot of conceptual and technological challenges. And some of these challenges we'll get into details in today's discussion. Overcoming these would require a significant amount of investment in technology and cultural changes. So as a result of that, he made the prediction that it would not happen for another 20 years or another 16 years. So that's what's about the mandate, the required mark-to-market. But if it's not a mandate, how about an option? Actually, both IFRS and US GAAP have provided an option for banks to fair value their loan commitment, outstanding loans, to market. So as you know that IAS 39 became effective on January 1st, 2005, and it was amended in June that year to include a fair value option eligibility criteria, and the criteria basically was intended to encourage best practice in terms of risk management. So the 2 criteria are, one is that if such valuation choice align accounting practice with risk management and investment strategies, or eliminate significantly reduce accounting mismatches. What does this mean? So a lot of the credit portfolio management function at banks, they take a lot of hedging decisions through credit default swaps. These hedging transactions are generally fair valued, mark to market, but they're trying to hedge the underlying book. So, if the underlying loan book is not fair valued, you will see the mismatch because there's quite a bit of volatility on the hedge book. So definitely one of the intention of this fair value option is to mitigate that. Now, for the US GAAP 159, it was published last year, February, become effective November 15th last year, and there was no eligibility criteria. But both IAS 39 and FAS 159 do have some requirement, which is the election must be made at the beginning, and you cannot change that afterwards. So this is to prevent people to game the system. Otherwise people will only choose the option when it's favorable to them, and otherwise it's not. And you can only do this for the entire loan commitment amount. A lot of the loan commitment may have several pieces, so you have to do it for the entire loan commitment. Now, let me talk a little bit about how banks using the mark-to-market practice, other than just reporting. Of course, reporting is very, very important. The active use are around, first, risk monitoring. What do we mean by that? When banks look at corporate credit, when they do risk management, they usually look at their ratings, market prices, probability of default, loss given default. But price is probably the most direct benchmark of the value deterioration. So if you turn the ratings or PDs into a market price or fair value based price, and if you see that the loan when you started at 100, it went to 93, that's the indication that the credit is impaired. So that's the first application. The second one is hedging decisions. So if you bank, you have 300 million credit lines to company XYZ, and also you hold 500 million bonds to this company, and you have another 1 billion term loans. So that's quite a bit of concentration to this specific company. How are you going to manage risk? So if your limit to this specific company is only 500 million, what you can manage the concentration is by taking the buy credit default swap to mitigate, to hedge the exposure to this specific company. And how much do you hedge is very much a function of the market value of the exposure you have to this specific company. So that's another application. The third area of application will be loan pricings and origination decisions. So when company XYZ come to the bank and say, I need a $500 million loan with 5-year maturity, and how do you determine the price? Right? You're going to do a risk assessment. Right? You're going to do your homework. But one piece of homework is that you can just go to the market and say, if I buy a similar loan, how much do I have to pay? What kind of market spreads can I get on similar loans? That's the most direct way to do loan pricing and consider whether it's worthwhile to originate such a loan. Right? This implies another area of application of the mark-to-market of loan books, which is measuring the true cost of relationship lending. I always find it's funny that when they call the lending relationship a relationship. What kind of relationship which is you get money just from, the money goes from one side to another side. And it's very, very, very much one-sided relationship. But bankers call it relationship lending. One of the argument that these commercial bankers say that, why we need to do this loan for this specific company, well, because relationship, because we get a lot of cash management business, because we get a lot of merger and acquisition business out of this company. So we have to give them this revolver, even though we lost money on this revolver. So the question, that's fine, that argument is legitimate, as long as you know that what's the true cost of giving this revolver to this client, because that's the only way to truly measure the underlying economics. Okay? So you can see that there are a lot of economic use of fair value practice of loan book. Now, of course, there's also passive uses. By the way, active, passive, the tone probably is not right. I don't want to belittle the importance of the communication and reporting aspect of the application of mark-to-market. Actually, this is quite important. How you use the mark-to-market values in communicating the hedge effectiveness and communicating how you manage the portfolios. So what do I mean by that? So when the credit portfolio management function of the bank demonstrate how effective they have been doing their job in managing the loan book, the one way they can do that is to look at the P&Ls on their loan book and combine that with the P&L on their hedge book. And that's the most effective way to communicate how effective they're managing the loan book. And the after-fact reporting is that you can actually decompose the P&Ls into various factors. To enable you to do that, to enable the banks to do that, you have to be able to fair value these instruments. Okay? Now, so you can say it's very, very useful. If you have been reading financial press, the topic of fair valuing the instrument on the books of financial institutions has been hotly debated. And if you read the Financial Times last few days, you may have come across with the following story. Recently, the Institute of International Finance, which is industry body of financial institutions, which consists of 300 plus banks, investment banks, insurance companies. In their April 2008 report, which report on the best practice and what's happened in the turmoil and what are the recommendations, they actually have quite a bit of a section on fair value practice. And then I took some main points from that section. They criticize that there had been significant deviation of mark-to-market value from the true fundamental value. Right? If you look at that for a moment, that seems to suggest that somebody actually know what the true fundamental value is, right? Maybe somebody do. One of the biggest criticism is that this exacerbate the market stresses. So it put additional pressure on downward spiral on asset prices and forced further write-downs and liquidations. Right? Some of these criticisms does have merits. I'm not belittling the importance of these points. I'm just laying out the argument. The Financial Times further reported May 30th, 2008. So you can see that when actually I worked on the presentation. I have proposed to relax some of the classification for financial statement and to ease the rules in times of financial stresses. So they cannot take further write-downs. It claims that the taking prices in liquid market result in valuation that do not provide true picture of financial positions of firms. Okay? What do you guys think of the proposal? I see people shaking hands. Sorry, shaking heads. Goldman Sachs called the proposed change Alice in Wonderland accounting. Okay. So that's the context of what I'm going to talk about today. You can see that this is a very contentious subject, and it has been hotly debated, and it's going to be continue to be so probably for a while. But my discussion today is going to be focused on valuation of corporate credit, so bonds, loans, and CDS. But a big part of the discussion today is going to be on corporate loans, and you will see why. Some of the principles I discussed today probably can be applied to other asset classes, but the focus is on corporate credit. And I'm going to focus on model-based valuation, because that's probably the hardest piece in this context. And that's where our expertise lies. I'm going to talk about modeling issues, lessons learned from recent market turmoil, and cross-border issues. And before I get into the discussion, I need to provide the caveats. The views expressed in the statement are mine only, not necessarily of Moody's, even though, of course, I'm very grateful that Moody's and Moody's KMA provide a lot of statistics and research support for today's presentation. So that's why you see the copyright logo is still on my presentation today. But I want to see that the views expressed today is purely mine, may or may not reflect that of Moody's. I don't want to give you the impression that I know a lot of answers. I don't. I do want to raise questions, and hopefully I stimulate further research and debate in this area. So that's a long-winded introduction. Let me get to the quantity stuff, the loan valuation framework. So first, let's talk about the general valuation framework. And how do you value a corporate credit is actually, as what we saw in FAS 157, you basically follow the hierarchy of level 1 assets, level 2 assets, level 3 assets. So the first one is you basically use market prices if available. Now for corporate credit, for bonds, loans, and CDS, a lot of these market prices are not necessarily transacted prices, unlike equity market. So a lot of them actually are really dealer quotes. Okay. When you choose these sources, usually you try to put some hierarchies around which source you pick first. So for a specific bank, if they believe that their trading desk is best, so you can specify that, the bank will specify that they pick their internal trading desk source first. And then they take, I'm just making up the example, market partner, which is one of the dominant players in the space, and followed by loan pricing corporation and things like that. The second one is use direct inputs which are market-based. So, for example, when you try to price a loan which is not traded, but you can go to CDS market to get a quote on a contract with similar maturity, but to the same reference entity. Of course, you have to adjust other parameters such as loss given default, because loans are generally secured. CDS contract is generally for unsecured credit. Okay? The third one is the model-based, and usually you need to apply some sort of model, which I'm going to get into details. And the general approach is that you need to calculate default probabilities, loss given default, and preferably from market sources. And then you need to model instrument-specific characteristics, such as prepayment options. Again, I'm going to spend quite a bit of time on the third approach, model-based. Okay, so that's what I'm going to talk about next, to really prove to you that indeed I'm a quant. This is the equation. This is basically a fancy way to write a discounted cash flow model, but in a more finance correct way. So the value of defaultable loan is basically discounted value of expected value of all the future cash flows under the risk neutral measure. What do we mean by risk neutral measure? You basically adjust the physical probability, what's actually going to happen in real world, by risk premium, by basically inflating the default probabilities to account for the risk preferences. And then you just discount that at a risk-free rate. So it's basically the same framework that you can derive Black-Scholes formula, the same framework that people use in derivative pricing. Of course, this is very much in spirit similar to discounted cash flows. Now, what makes the problem especially hard for corporate credit, especially for corporate loans, is that the cash flows are not fixed. So the promised payment is actually not really truly promised. It is contingent upon credit states of the borrowers. So how the credit quality of the underlying borrower has big impact on these cash flows. So, for example, the borrowers can prepay if it's find worthwhile to do so. And when does the borrower feel that it's worthwhile to prepay? When he finds that it's cheaper to get another loan to replace the existing contract, right? There are other optionalities in the loan contract. So, for example, if you have like a credit card, right? The equivalent of credit card for corporates is revolvers, right? You have the option to draw down on your credit cards. So that's the credit lines. And when the firms get into trouble, when their financial health deteriorate, they have more incentives to draw down on their credit lines. So there are a lot of optionalities which are quite complicated, and I call them not covered by Zhang Hao's book. Of course, I assume that you know Zhang Hao's famous book on options, futures, and derivatives. Even at if I remember correctly, current version is the 7th or 8th edition. When I went to graduate school, it was probably the first or second. Still, these options are not really covered by Zhang Hao's book. So what are these options? I already talked about prepayment, about revolver usage. Another example, what's so-called grid pricing. So the commercial bankers are quite clever. So when they gave a loan to a bank, got it backwards. When they gave a loan to a customer, they say that I'm giving you 3%, very good rate. But it's like a teaser rate. If your leverage ratio increased to 70%, you have to pay me 10%. Okay? That's so-called grid pricing. If your rating deteriorated from triple B to single B, you have to double the spreads. You have to double the coupon rate. That's called grid pricing. That's another example. Term out option. So when you have a revolver you may have the option to turn that revolver into a fixed loan with fixed maturity with pre-arranged coupon rate. So that's another possibility. The 4 optionalities that I listed here are the major ones. Actually, there are tons of combinations of optionalities in these contracts. And you have to wonder, when people actually design these contracts, did they really know how to value them? Now, to summarize what we discussed, what would be the drivers in determining the value of loans? So there are a number of them. The first one is recovery rate, because the value of the loan today is the expected value of future cash flows. If the loan gets into default, what kind of recovery value you will get out of the loan. So that plays an important role. Spreads and fees, these are how much you get paid on the loan. Maybe the liquidity play another impact. The amortization schedule, default probability, and credit migrations. Actually, this one plays a central role because that determines how the cash flows will be probability weighted, and also determine how the cash flows will be determined, because a lot of these cash flows are credit states contingent. Revolver utilization is another one. Maturity, prepayment, investors' risk appetite. So there's a lot of drivers in determining the loan's value of loan. Now, next few slides, I'm going to talk a bit about how do you model credit migration. When people talk about credit migration, what most people are familiar with is how the rating evolve over time, how the rating change over time. And that's fine for certain purpose, but for loan valuation, because we're looking at mark-to-market value, it may be insufficient. Let me give you an example. On this chart, we're showing you the quartiles of the CDS spreads, credit default swap spreads, median CDS spreads for all the Moody's Baa rated US corporates in the last 5 years. So the red line is the worst 25 percentiles, the green line is the median, the yellow line is the best 25 percentiles. Now, all of them are rated Baa at a specific time point, actually every single time point. So if rating is truly a value of market value, we should be expecting to see flat lines in the last 5 years, right? But what we see is that spreads fluctuate quite a bit, even for the same rating, right? By the way, certainly this is not a criticism about rating, because rating, as the definition provided by all the rating agencies, it's their opinion of either expected loss or probability of default. In their definition, they have never explicitly said that it's a yardstick for market value, right? So my point here is that we need to be careful with using credit, using rating transition to model credit migrations, because that provides a very distorted view, which I'm going to show you in the slides. So if you look at Moody's published 1-year rating migration matrix on the actual rating changes, there are a lot of numbers to look at. Let's just focus on one number, which is the probability that you start off with BWA and stay with the BWA. If you do it through the lens of rating transition matrix, you get 88%. So very likely you end up where you are if you're rated BAA. But if you decide to take a different view, which is you truly measure the probability of default, which we do at Moody's KMV using market information, and then you translate that probability of default into rating equivalent, then the probability that you stay where you are with the same credit quality is only going to be 46%, almost 50% less. That's a big difference. So the credit migrations through the lens of rating transition can be, if you use that, you could be underestimating the migration risk. So the way we do it at Moody's KMV is actually model the PD migrations using our probability of default framework. We call it expected default frequencies. And we actually built a lattice model to value corporate loans, to give you a flavor of how we do it. So here, suppose you have a loan with 5-year maturity. You start off with time 0, and you're trying to get the value of loan today, and you do it by looking at all the possible migration paths in terms of the probability of default of the specific borrower over time. And each node on the lattice represent the possible credit states of this borrower. And you can see that within such a framework, you can model the contingent cash flows. So for example, at time period 2, now if you migrate from, let's say, credit states labeled by 6, which is how far away you are from default, to, let's say, call it AAA, because your loan initially is priced with a much lower credit quality, now you become one of the best. Certainly you'll be able to get much cheaper loan in the market. So it makes sense to prepay. So in that node, the loan will get prepaid. Below that node, maybe the loan will not get prepaid, but for that node, you may be able to get away with lower spreads. So those are for the credit improvement. For the cases where actually credit deteriorated, the worst case is, of course, the credit states hit the absorbing boundary where the company defaulted. So in that case, you have to value the recovery. For the case where you have credit deterioration but without default, the revolver may increase the usage. And that you can model that as well. So that's the framework that you can use, which truly account for credit migration as well as these optionalities, the state contingent cash flows. So we built such a model. Let me, in spirit of time, let me speed up a little bit. We have seen these squares. Out of these drivers, actually a lot of them, you actually can get the information from market. So recovery, you actually can calculate market implied loss given default if you have a way to separate out other component. Same applied to default probability. Either you can use equity market to calculate the probability of default, which Moody's KME does through the expected default frequency model, or you can take CDS spreads and bond spreads and imply out the probability of default. Liquidity and investor risk appetite can also be back out from the market information. What I'm trying to see here is that for a specific credit, you may not have a specific observable market price or dealer quote, but there are comparable informations that you can extract from other market that you can use in the model-based calculation. And this is what we do actually on a daily basis at Moody's KME. Let me just to convince you that such model actually can provide quite a bit of close match of observed quote. We actually did we did 2 validation studies. One is use loan X prices, another one is loan pricing corporation prices. And the chart you're seeing is from 2002 to 2006. By the way, we're in the midst of updating this study to include the last 2 year, almost 18 months of data. What you're seeing on the chart is the difference between the modeled price and observed quote provided by loan pricing corporations. And we did it for the term loans as well as revolvers, the credit lines. And you can see that on average, they provide quite a bit of close match. Now, I'm giving you a very aggregated picture here. There are a lot of issues when you do a validation study because as you will see later, actually there are a lot of issues in working with such a data set because a lot of these quotes are quite stale and a lot of them are somewhat dealer made up prices. So you have to be very careful with using the data set. 2 is there are a lot of optionality issues you have to deal with, and also there are a lot of data issues that some of these loan contract, the specific characteristics are not truly recorded when you get the data. So the short message here is that such model can provide a pretty good close match for the population where you actually do have observed price. So that's the valuation framework. Now let me talk a little bit about lessons learned from the recent market turmoils. The first one I would like to say, last 2 weeks I've been visiting our clients in Europe, and for every single conversation, and people always like to talk about what actually happened, what's happening, what lessons can we learn. I always like to start off with say, we're still in the midst of it. In the fog of war, events are still unfolding. So we need to be careful with definitely conclusion, because you see a lot of write-downs, and these write-downs are primarily on subprime mortgages and leveraged loans. The write-downs haven't truly occurred for credit cards, auto loans, CMBS, and the typical corporate credit. So these defaults will happen eventually. So a lot of the discussions, we have to put these discussions in that context. Right? Of course, I'm raising this point to really hedge for myself for what I'm going to say next. When I hear these debates, when I read what's published by the regulators, what's debated in the financial press, I have always wondered that some questions that are so obvious that they're somehow rarely asked. Why is why is the corporate credit market illiquid? You can apply the question to why is the CDO market illiquid? Why is the MBS market illiquid? Right? Now, if the market is liquid, we wouldn't be having a discussion at 8:30 on Saturday morning in London, right? Right? So it's a question so obvious, right? Of course, I can provide some answers. There's information asymmetry. Banks, borrowers know more about loans than the investors, right? The payoff symmetry of investing in credit, upside is capped. The best you can do investing in corporate bonds alone is that get your principal back plus the promised coupons. Unlike equities, you can get a huge upside. But the downside is that you can lose the shirt. So there's not much incentive in actively trading in the underlying credit. Of course, unless you can short, unless you can take the derivatives, because if you flip the return distribution, the huge downside, if you take the other side of the transaction, you can get quite a bit of upside. Actually, in a sense, that's what happened. If you think about how the house bubble got popped, is because one of the reasons many hedge funds actually actively shorted ABS indices. I would argue if there were not ABS indices, that hubris might have gone on a little bit longer, because you can't really take the other side of the transaction betting against the fall of house prices. The other reasons for why the market is liquid, institutional setup. Right? If you look at how the market is operating, it's basically institutionally intermediated. It's really just from one. It's because of institutional concern. It's not through a market-oriented exchange. It's not through price. Right? So, if you really think about what we're talking about, the asset classes, corporate loans, corporate bonds, CDS, they're all derivatives on the underlying cash flow of the business, the same as stock. So the natural question to ask is, why is stock market much more liquid? Well, the stock market goes through market stress as well. You haven't heard any people complain using equity market prices under stress for valuing their stock portfolio. Have you? Right? So, and these questions haven't been really asked. Maybe I haven't done enough research, but I haven't seen a lot of these questions debated. And naturally, this leads to the question, what needs to be done to make the market a liquid one? Because, as you are economist, if you're a believer in market, holding everything equal, market is the best way to intermediate, the resources, right? So anyway, I would like to leave those questions to you to ponder. Let me spend a little bit of time on talking about the liquidity or lack of liquidity in the market. Even in the normal market conditions, there's tremendous of illiquidity in the market. On this chart, you're looking at monthly changes in the loan quotes reported by loan pricing corporations. You can see that the distribution is heavily centered around zero. Actually, 57% of monthly quote change are exactly zero. So there are a number of interpretations of this. One is that the price is just very stale. Of course, there are also possibility that the quality hasn't really changed. The market price really hasn't changed. But if you look at what's happening on the CDS market, what's happening on the equity market, you have to ponder how likely that's the case, how likely is that these prices are just stale. By the way, the period that I'm showing you here is 2002 and 2006. I'm going to show you a graph for the most recent period. Now, when you look at this picture, you have to wonder, these quotes, and these are actually dealer quotes. So these quotes are the appropriate for the purpose of mark-to-market purpose, right? Actually, we would like to make an argument that you can gain quite a bit by bringing in the information from other sources, from CDS market, from equity market, from bond market. Okay. Let me show you what happened in the recent market turmoil. The two lines you're seeing here, the red line is the bid-ask spreads for the. This is averaged over a very large universe. This is reported by Loan Syndication Trading Association. You can see that the bid-ask spreads went from 50 basis points March 2007 to at the height of this, which is around when Bear Stearns was rescued, you get 225 basis points. So to put this in the context, the transaction cost for corporate bonds, under normal conditions, investment grade bond, the transaction cost is about 15 basis points. For non-investment grade, it's about 30 basis points. 225 basis points. Right? You can do your own calculation about the market liquidity. And the other line is the blue line is the average of mark-to-market price of these loans. And you can see that at the worst case was something like below 70. Okay? Another lessons, what happens and what happened to these financial institutions. These institutions thought that they can value a lot of the assets using level 1 classification. With the market turmoil, these assets actually quickly turned to level 2 and level 3 assets. And the dealer quotes are either totally disappeared or become extremely distressed. And a lot of the institutions actually didn't have a backup way to value them. They didn't have the model, they didn't have the technology to model these instruments because they assumed that they can get the dealer quote price or market price on this instrument. And a lot of the institutions either didn't do stress testing or in hindsight, the stress testing they did was insufficiently distressed. Another lesson, the embedded options and the counterparty risk do matter. We actually have empirical evidence which find that companies increase the credit line usage when the default risk increases, when they got into trouble, and during economic downturns. So when you gave an option to somebody, you better prepare the chance that these options will get exercised. If you actually read the details of Citibanks, why they actually stuck with a lot of the senior and super senior tranches of the CDO investment, actually in some of these contracts, they gave investors options to actually put these contracts back if a certain degree of impairment, credit impairment occur. Citibank saw that these options were not ever exercised because they're truly deep out of monies. Well, it turns out that actually it's not that deep out of money. Another point, revolver usage can be very high. So for example, we actually look at the data of US middle market revolvers. The usage given default, the amount of drawdown at default can be almost as close to 100%. The median is around 90%. For large firms, it's a little bit lower than that, but still it's in the range of 70 to 80%. So these optionalities do matter in determining the values. The value of, another point I want to raise, the value of CDS contract can vary with counterparties. So the counterparty risk becomes very much manifested in the crisis. Imagine that you bought a CDS transaction on Sharper Image. By the way, you probably don't, I don't know if you're aware that Sharper Image filed for bankruptcy, I think in March. If you bought a CDS transaction, a CDS protection on Sharper Image from Bear Stearns in March 2008, the contract is basically was worthless in March. So, yes, okay, I'll try to speed up. Cross-border issues. Naturally, the issues are around consistencies, right? Are you using a consistent framework? Are you using consistent inputs? There's actually quite a bit of empirical research that suggests that there are cross-border differences in recovery rate, in the market risk premium. I'm not going to get into details. The slides will be available for you so you can study them themselves. So let me provide some closing remarks. So by now you probably understand my very subtle position on the marking to market. There are a lot of benefits of marking to market loans because it provides transparency around credit risk management, around timely measurement of credit deteriorations. And I want to point out that holding everything equal, accrual counting is another form of mark-to model, right? A lot of criticism for marking to market is about marking to model, right? If you see that the accrual accounting, the cost-based accounting is just another form of marking to model, right? So if you want to take the debate to that angle, then we have to debate the merits of these models, which include accrued counting. I want to see, I mean, there's other benefits, which hopefully I'm preaching to the choir. But I do want to see that what I've been discussing is actually a lot of this is from the experience we have been working with clients in the last 5 years. Believe it or not, we actually started research on providing technology, which means model data and software solutions to clients to market their corporate credit book since 2003. So I actually have quite a bit of experience working with clients on this. And a lot of the insight I'm sharing with today actually from that perspective. So I'm going to end my talk with some food for thought, some potential academic research topics. Certainly at Moody's KMV, we have been contemplating these issues. If any of you have interest working with us, please do let me know. Now, there are quite a bit of interesting research topics as we see in this area. The first one is around the relationship between commercial banks' earning qualities and stock valuation with its risk management practices, with its accounting practices, how they disclose on their financial instruments. We actually have quite a bit of data on these issues. If any of you like to work on these areas, please with us, please let me know. A lot of the debate currently on MTM practice is the context of regulatory capital requirement. I want to make a remark that the debate has been somewhat, in my opinion, be too narrowly focused on just the accounting aspect instead of regulatory capital requirement. So maybe some of the solution is not actually changing the yardstick, but because, in my opinion, the yardstick truly reflect the economics of the underlyings. Maybe it's you look at how you define regulatory capital, and from the risk management perspective, how do you use them? So with that, I'm ending my discussions, and if you have time for questions, I'll be happy to take some.
Indeed. Thank you very much, Jing.
Thank you.
Very interesting. Allow me to be a schoolmaster here. We did start 5 minutes late, so I think we have a bit of time for a few questions. Yes.
I might try to sneak in 2 questions, but
Sure.
one is then, if in your valuation model, how do you factor in some of the external realities, such as if the market actually collapses for the particular instrument that a company is holding? Does that make sense?
There is a component in our valuation model. We call it as a proxy for liquidity, and it's a function of the issuer's size, firm size, and we find that it's a good proxy for liquidity. I don't want to claim that we count all aspects of that, so that's one angle you can look into that. 2 is that if you want really you can really increase the probability of default you use for that specific name. That's another way to try to approximate that.
But something like where the auction rate securities market, simply there's no way to find a buyer for the seller. How are you maybe updating your model for some of these sort of new black swan, perhaps, events that people hadn't anticipated, where the whole market just goes away, regardless of the size of the company or the issuer? Does that make sense?
Yeah. Well, if the whole market goes away, you have to say, let's look at, say, just independent assessment of probability of default, the loss given default, and you have to rely on these informations. You have to get these assessment without market information. Right, so you have, because the market is not there, so you can't really get market assessment. And there are ways to assess PDs and LGDs without using market informations. Yeah.
And then the last one is just, and maybe, is if level 2, when you're seeing companies suddenly have level 1 assets go to level 2 and level 3, mm-hmm. How are you all thinking about that? So, what we do in our tool is that actually it provides a valuation hierarchy. So you specify, say, if there's market price available, I'm going to use it first, and you can pick market sources. If there's no market prices, I'm going to revert to either level 2 or level 3 valuation, because there's always model-based valuation. So that guarantees that you will always has a mark, because there is a model-based. There's always going to be a model-based price.
Jing, can you comment, so as we move to fair value accounting and start doing more and more of this, is there an expectation that the rating agencies, that these ratings will start becoming a lot more volatile as we go into the future? Is that an expectation that you folks at Moody's and S&P would share?
It's probably harder for me to comment on that, because Moody's has 2 operating entities: the Moody's Investor Service, that's the rating folks, and Moody's Analytics, which Moody's KMV belongs to, which is non-rating risk management business, and that's where I work. So it's probably harder for me to comment on that.
So this question is related to your slide on the value drivers for loans.
Right.
I actually noticed that you did not include the quality of the firm's assets there. You only included options that are attached to that loan, or maybe I missed that.
The quality of firm's assets?
Yes, I mean, most of these loans, as you well know, they are secured and they are very senior, and the recovery rates are actually very high. So I was wondering too, how do you measure the quality of the firm's assets when it comes to recovery?
Okay. The quality of firm's assets reflected both in probability of default as well as loss given default on a specific instrument you're talking about.
For recovery, actually, we do have a model which explicit model the loss given default as a function of, say, collateralization, subordination, leverage, guarantees. So there is a way you can model that, and we do that in one of our models, loss given default model. Is that what you're asking?
I guess I asked how you do it, how you measure the quality more exactly. So
the quality of a specific loan, or you're talking about the underlying
assets that back these loans.
Sorry, you're talking about the underlying business quality, or you're talking about the quality of that specific loan?
No, the assets that are used as collateral for this loan.
We don't do explicit modeling of that underlying assets, because that's very hard. You have to actually look at what kind of asset it is and the cash flows. We don't do that. Yes, please.
Could you say something about who was responsible for the mispricing of the subprime mortgages? Was it the credit rating agencies, or was it the banks?
I'm speaking as just an individual, and have to be very careful because I work. My parents. You got to be very careful with when you talk about your parents. I would think that there are plenty of blame to share, right? I can quote what the ex-president of Moody's Investor Service said, Mr. Brian Clarkson. He said that we expected a storm, and we got a tsunami. Right? And the banks, they are the one actually wrote these loans, right? These guys wrote these mortgages, and mortgage brokers, and frankly, the investors, right? Right? And the regulators. And I would argue that there are plenty of blame to share.
Based on your experience working with your client in the last 5 years,
Right.
Can you give us a sense of the precision of those estimates from those models for the typical level 2 or level 3 instruments? I mean, I understand that you can all have a model and you can put out estimate, but how much can you actually trust those estimates, and how useful would that be for accountants if you want to put them on the financial statements?
Right. So that's a very important question, which is around validation. And we actually have done 2 rounds of validation studies. The first one is using loan X prices. The second one is using LPC prices. These are 2 dominant players, providers of loan prices informations. And what we find is that actually for the ones we think are liquidity traded, the match are pretty good. And we also have done exercise try to understand why we see mismatches. So what I can see is, by the way, actually we do have the reports, and these reports are publicly available. And I should say that I have a list of suggested readings in my last slides, which you can take a look, and provide actually a lot of statistics of the performance of the model. And the banks who have been using our tool have also done their individual validation studies.
One more quick question.
I was curious about, one of the objectives of rating agencies, I think, is to balance is stability, in addition, obviously, to timeliness and accuracy, and you're trying to balance those. And I was trying to get a sense of how much weight you place on stability, and this is especially relevant, I guess, when there's some kind of macro crisis where the value of the asset at fire sale prices is obviously much less, and probably not reflective of what you'd get in an orderly liquidation in better times. And so, how far ahead do you look to see at what point would we be able to get an orderly liquidation, and so have prices that are more reflective of maybe the underlying or the fundamental value, and that are not fire sale prices? So how much weight do you place on that stability?
Excuse me. I have to apologize again. I've never rated a deal in my single life and never signed a rating, so I truthfully, I don't know how the rating process works. I have the same access to the public available documents as any of you guys, because there's a strict Chinese wall between what we do and what rating analysts do. But I can provide you our view how we trade off between the stability and the forward-looking aspect. So if you look at, we provide probability of default estimate from 1 year up to 10 years. And our approach is that we can argue that these measures are too volatile. I always find that argument a bit of amusing, because the implication is that what's the underlying level of volatility is when you say it's too volatile. But I'm not accusing you, implying that in that argument. But I think what we have observed is that banks or the users of these measurements, whether it's PDs or ratings, is that in the effort to try to manage these volatilities, they actually mask the accuracy of these underlying measurement. In my opinion, a better way to do it is that not decrease the accuracy or the forward-looking aspect. You cannot have something which is stable and forward-looking, right? That's period. So you have to just take that as a fact. Then you measure, you manage the volatility differently. Actually, the fact is that if you're in the market, you are in for the volatility. That's just the aspect of the market. So we should separate the measurement from the management aspect. That's how I would look at it.
Okay, and with that, thank you very much.